Today, we're going to lay out a step-by-step plan to achieve a $1 million portfolio as fast as possible in the stock market. So if you follow this plan, you are going to become a millionaire. The question is how fast, and this depends on how much you want to commit to it. Everybody says, I want to become a millionaire, I want to become rich, but not many people are actually willing to follow through on a plan with consistency and with sacrifices. Now consider that when I started investing, and it wasn't so many years ago, I thought it would have taken me 40 or 50 years to become a millionaire. I was making my calculations, like I always do in my Google files, thinking how much I want to invest every month, and assuming to get around 9 to 10% per year from the stock market. And when I saw the results, I said, oh, I actually thought I would get there faster. After all, who wants to wait 50 years to become a millionaire? So I was discouraged at first, but just a couple of years later, now I'm already a third of my way there, and I'm confident I will get there at the latest in 5 to 10 years. And why is that? Not because I have a secret ETF recipe that gives 25% per year, but because I understood that there are many other aspects that, together with the right investing strategy, are going to make you build wealth so much faster. My name is Rick, your favorite ETF investor and twin of Manu Ginobili, and this is my step-by-step plan to grow your portfolio to $1 million. The first step, and I'm going to be quick on this because most of my audience already knows it, is to forget about risk investments or even single stocks. Play with them if you wish, but focus your long-term investment strategy on solid broad-based ETFs like VOO, the S&P 500 from Vanguard, or the total stock market with VTI, together with some other solid ETFs if you want, like QQQ or SCHG for the growth sector, SCHD for the value sector, and VXUS for international markets. Now everybody's talking about Bitcoins, and I do have Bitcoins myself, but what people don't realize is that when everybody knows about something, it's already too late. If you believe that a single Bitcoin is going to get to $1 million, I have no physical proof that it's not going to happen, but I want to show you this. Look at the growth of Bitcoin since 2010. So what is the impression that you get by looking at this chart? For sure, not that the growth is speeding up. The blue curve you see here follows a logarithmic regression, meaning Bitcoin's growth is slowing down. In the early years, Bitcoin went from a few cents to hundreds of dollars. So a 10,000x return wasn't unusual. But then it took a longer time to go from $10,000 to $100,000. And this is only a 10x return. And the curve suggests that relative gains in the future are going to be smaller and smaller. So the big boom phase is likely over. The second step is the most painful one, and that is understanding that if you simply invest on savings every month, you're not going to get rich quickly. One of the many reasons for this, not the only one, but one of the many, is inflation. Let's say you invest in the S&P 500 index, and you've heard from many YouTubers, including me, that in the long term, the S&P 500 has been delivering around 10% return per year. And let's assume that it's going to be like this in the future. So you download the free compound interest calculator that I created, which by the way, you're going to find link in the description of this video, and you start playing with the numbers. Let's say you've got $0 now, you have 10% return per year, and you plan to invest $500 per month. You find out that with these deposits, you're going to achieve $1 million in 29 years. So in 29 years, you're officially a millionaire. Then your grandfather comes in and tells you how he was able to buy a house when he was 16 years old, and he was already married with 14 kids to feed. So you're astonished. You ask him, how much did he pay for the house? And he tells you, $40,000. So how is it that you could pay 40 grand for a house and you need $500,000 for it now? Because of inflation. Considering an average inflation of 3% per year, we're basically taking into consideration that every year the dollar loses around 3% of buying power. In other words, if you have $100 in your pockets now, in 1 year they're going to have the same buying power of $97 today. So let's add 3% inflation here, and you notice how, yes, you're going to achieve $1.1 million in 29 years by investing only $500 per month, but they're going to lose 58.8% of their value because of inflation, leaving you with $465,000 inflation adjusted. So now that we got inflation out of the way, we realize that if you want to become a millionaire quicker and you want to do that by investing in the stock market, you're going to need to increase the amount that you invest every month. And there are two ways of doing this: a short-term and a long-term one. The short-term way is going to be to reduce your expenses as much as possible. I know it sounds easy, but it's not. But it's truly the quickest way to increase that delta, the amount of money that you're able to invest every month. If you manage to even increase from $500 to $700 a month, the number of years that you're going to save is tremendous. If you have no idea where to look for saving potential, trim what I call the big three: housing, transportation, or food. Can you, for example, downsize your rental or buy a smaller house? Can you reduce car costs or maybe go car free? Can you cook more at home instead of always eating out or taking food delivery? And look, in this video, we're also going to touch a lot of aspects that are investing related, but I had to get expenses out of the way because this is going to help you much more than just choosing the best ETFs and stocks. Step number 3 is what I call the 3 income strategy. This is the long-term way to increase your monthly investments and comes not by working on your expenses, but instead by working on your income. With investing, you're not going to get more than 7 to 10% growth per year anyway on average. So the only way to speed up the process is by increasing the money inflows that you can use to invest. So when I started investing a couple of years ago, I understood right away that I had to go 3 routes at the same time. Reduce expenses, increase income from my regular job, and create new sources of income that can potentially make me even richer than investing in the stock market itself. So the question I was always asking myself was, how can I make more so that I can invest more? And this must become your new favorite question. And how do you do it? I call it the 3 income strategy. You need a job that delivers you a safe, continuous income. You need a side hustle that can possibly become your main occupation or your main source of income, and we'll see later how. And you need to constantly invest your money either in the stock market or in improving yourself to become more valuable for the marketplace. If you want to accelerate your wealth growth, you need to work on all these 3 simultaneously. Remember, your job pays the bills, your side hustle grows optionality, your investments builds freedom. When it comes to the job, you need to maximize your salary. So either you can look for a similar job with a higher salary, which is always possible, or you need to expand your options by learning something new. When it comes to your side hustle, I'm not going to suggest you pet sitting, food delivery, or landscaping. Instead, what you need is something that might bring you no money for a while, but that has the potential to become a real business in the long term. So how do you recognize if your idea has this potential? Need, entry, control, scale, and time. These are the 5 criteria your idea needs to have. Businesses satisfy the needs of people. Don't chase money, rather look at how your business will help other people. This is need. Is your idea something hard to do or something that not many people do? This is entry. You need an idea with a certain entry barrier, otherwise competition will make it impossible for you. Then, control. Do something that you can have control over if you were to become a business. So for example, don't open a McDonald's because you'd be at the hands of the franchise. Scale. Whatever your idea is, it must be scalable without you being constrained by physical limitations. And lastly, time. Your business should detach you from time, because if you want to earn 10 times more than a normal person, you can allow yourself to work 10 times more hours. Step number 4 is to increase contributions. If you work on your 3 income strategy, you'll be able to increase your contributions in the stock market over the long term. Now, to give you my personal experience, before focusing on the 3 income strategy, up until 3 years ago, my earnings every year were pretty much flat. I was getting something like a 3% raise in salary every year just to fight inflation, but this is not how you make money. In the past 3 years, I focused on increasing my skills, the right job selection, and inside businesses, and I managed to double my total income in 3 years. And this without even considering the returns from the stock market. So if you look around, you're going to find many ways to improve your income. But the most important thing is, when you do, invest your raises, not your lifestyle. Every time your salary goes up, you always face a choice. Lifestyle inflation or portfolio inflation. I always keep the same exact lifestyle, so whatever salary increase I get, even if it's just $200 more, means $200 more invested every month. So make it a rule and invest 100% of every raise you get. Step number 6, use dollar cost averaging to buy into ETFs. Namely, invest a fixed amount every month regardless of what the market is doing. Now, this might sound like it's contradicting the previous step, because before I told you that you need to increase your contributions, and now I'm telling you to keep them always the same. But what I mean with dollar cost averaging is that you need to automate your investments to emotionally detach yourself from your investments. This doesn't mean that you can't increase your monthly investments every time you have more money or you get a raise. Always increase your DCA when you can, but keep the investments automated every month so that you don't make the mistake of investing more when the market is growing and less when the market is decreasing. Over time, the strategy of dollar cost averaging smooths out market volatility, and because you're investing consistently, you're maximizing your potential for growth. Step number 7 is don't invest blind, know what you actually own. Way too many investors buy ETFs without understanding what's under the hood. Either they only buy tech ETFs, or they buy cover call ETFs without knowing what they are, or in worst cases they buy derivatives and invest with leverage. The best way to become a great investor, in my opinion, is to listen to the great personalities of the finance world, which are not finance YouTubers and read books about it. So I suggest you read The Intelligent Investor by Benjamin Graham, who, by the way, was nothing less than Warren Buffett's teacher at Columbia University. Then The Little Book of Common Sense Investing by the great John Bogle, founder and CEO of Vanguard, and One Up on Wall Street by Peter Lynch, which is a book about stock picking that still gives you a valuable framework on how to invest in a stock market. Step number 8 is know that growth cycles beat value traps. People always say value stocks are safer. And that is true, but growth ETFs like QQQ or VGT have delivered outsized gains for those with patience. The trick is don't jump in and out, ride the wave. There is nothing wrong with any of them, but the difference is the goal you have. Investing in value companies, or in particular in mature dividend companies, is a typical strategy of dividend investors. And there is nothing wrong with it. But investing in companies that give a relatively high dividend yield means investing in companies that don't necessarily know how to better use that cash to grow the company. And most of the times, they are mature companies. So investing like this gives you stability, steady income, but little growth. That's why if you want to grow your portfolio quickly, you should lean more towards the growth sector. Growth companies are businesses that are expected to grow at a faster rate than the overall market. They often reinvest profits into expanding their operations, developing new products, or acquiring new companies instead of paying dividends to the shareholders. Think of firms like Amazon, Tesla, or Nvidia. Nvidia grew 1,423% in 5 years, while the total stock market 92%. So here are some great growth ETFs that you need to know. Number 1, VGT, the Vanguard Information Technology ETF. This ETF includes all tech companies from the American stock market. Number 2, QQQ, the Invesco QQQ Trust Series 1 ETF. QQQ is the biggest and most famous growth ETF. In fact, it's been rated the number 1 best performing large cap growth fund on the market based on the return of the last 15 years. Number 3, SCHG, the Schwab US Large Cap Growth ETF. This ETF tracks the performance of large cap US growth companies just like QQQ, but with a broader diversification and a lower expense ratio, making it a popular low-cost alternative for long-term growth investors. All that said, let's get back now to the ETFs and how to choose them. I already gave you some important ETFs you need to know and own, like VO, VGT, or QQQ, but let's say that you want to go and look for other ETFs yourself. How do you do it? Besides, of course, following my channel where I always talk about ETFs, both for American and European investors, when you're looking for an ETF, there are a couple of details you need to be aware of. A good ETF should have a minimum fund size of, some say $10 million, I would say 100 million. Managing less than this value means that there is less interest from the investors, and this translates into poor liquidity and wide spreads. Poor liquidity on one side means that it might become harder to sell in some critical situations, and wide spread means basically that the buy price is much higher than the market price and the sell price is much lower. The total expense ratio, or TER, which is a percentage of your ETF portfolio value that you're going to pay every year as management fee, shouldn't be over 0.30%. Usually with broad-based ETFs, it's going to be around 0.1%. But looking for specialized ETFs, you might find some really expensive ones, and you should be aware of this. When it comes to performance, always look at least at the performance of the last 10 years. Never invest in ETFs that are too young or that are too specialized or trendy. For example, I would avoid investing in an AI ETF just because AI is cool and full of potential, or a clean energy ETF only because I believe renewable energies are going to increase in the future. And you know why? Because 99% of the time, when you want to invest in something particular because you believe it has a lot of potential, thousands of people before you thought the same thing, and the price is already overvalued and doomed to a future crash. Then you should consider the number of holdings. There is not a magic formula here, but as a rule of thumb, you shouldn't invest in ETFs with less than 100 holdings. But now, what about taxes? We're seeing how to save more, how to invest better, but how can we also optimize our portfolio growth by avoiding taxes? The way is by taking advantage of tax-efficient accounts like your IRA or 401k. The 401k is a retirement plan offered by your employer where you contribute money each pay period, and your employer typically matches up to a certain amount of your contribution. So whatever your employer matches is free money and you shouldn't miss it. A Roth IRA instead is a particular type of individual retirement account where you contribute money after tax, but this money grows tax-free if you wait until you are 59 years and a half of age. Two other accounts you should know are the rollover IRA and the target retirement account. With a rollover IRA, you can roll funds from a previous employer-sponsored plan over to an IRA. This allows you to avoid paying any penalties while keeping a tax-deferred status of your retirement plan. A target retirement account instead is a diversified portfolio that, over time, readapts the mix of stocks and bonds based on how close you are to retirement, reducing the exposure to risk investments over time. Guys, come closer. Now, I hope I'm not asking you too much, but if you can, it would be great if you drop a like to this video and subscribe to the channel. It's really quick to do, it costs you nothing at all, but it helps my channel tremendously and hopefully helps you if you find my videos useful, because then you get notified when a new video comes out. So thank you so much if you do this, and I really hope to meet you again in the next video. Send me an email or write me a comment whenever you want. I always try to reply to everybody, and apart from this, I wish you a wonderful day or evening, and as always, I'll see you in the next video. Ciao!